China's CPI data was today reported at a higher than expected 2.7%, exacerbating concerns that China may miss growth targets for the first time since 1998. On the phone with me now to discuss this is Jonathan Fenby of Trusted Sources in London. Jonathan, China's inflation has rebounded to a 4-month high in June. Should we consider this data with some optimism, or is this just the latest evidence of weakness in the Chinese economy?
Well, this rise in the CPI inflation was something that we at our research service, Trusted Sources, have been expecting this year. We'd expected this to kick in at the middle of the year because basically inflation fell to an almost abnormally low rate of 1.8 to 2%. And what you've got now, and this happens regularly in China, is inflation being driven by food, and particularly by pig prices. The Chinese eat an awful lot of pork, and the pork breeding cycle and slaughtering cycle, which lasts for about 16 months, comes into operation quite regularly. So that's pushing up inflation. Plus, we've had steady wage increases over the last 3 years, increases in factory costs, some environmental equipment, and so on and so on. So this was quite largely expected, but at the same time, it's another factor which will complicate the setting of policy in the second half of this year by the new administration, because they'll be afraid that inflation will continue to rise. We expect it to reach 3.5 to 4% by the end of the year, and at that point, they will not be able to undertake monetary easing, which they might want to do if other sectors of the economy run into difficulties.
While inflation remains below the central bank's target, the People's Bank of China, like the majority of central banks globally, faces a policy quandary. Should it provide more support for a flagging economy, or should it tighten cash flow in an attempt to rein in earlier excesses? While Europe has gone down the route of austerity, what's the right option for China?
Well, there's an added complication in China, which is that the whole financing, funding, monetary side of things is in quite a fragile state, because the central authorities clamped down on lending by the big four state banks quite successfully. But the effect of that last year and this year has been that people seeking finance have been going to what's called shadow banking. That's to say trust products, wealth products, corporate bonds, and other means of financing. And that really got out of control and shot up. And we had a liquidity crunch just a couple of weeks ago in China, when basically there wasn't enough money to fund the obligations that have been taken on there to keep the machine going. So the government then pumped more money into the system, which they certainly hadn't wanted to do. What you've also got in China, the complication at the moment, is that the central authorities, the new administration of Xi Jinping and Li Keqiang, is very anxious, first of all, to stabilize the economy, secondly, to gain control over local government spending, which got out of control with the stimulus package a couple of years ago, and then to form a good foundation, a good platform for launching structural reforms of the economy, which have been put off for years and are much needed. So they've got an enormous juggling act to do here. We don't think that they will go for easing. We don't think that they'll undertake another stimulus package, even if growth stays at around 7.5% in the next quarterly figures, which are due out next week. But at the same time, from a political point of view, if the economy continues to decline, if unemployment rises, and if at the same time inflation is rising, they're going to have to take some steps.
The Australian dollar has dropped as this data dims export outlook. Chinese stocks remain volatile as gold, as we know, a great hedge against inflation, continues to advance. All this as the Bank of Japan also prepares to discuss China at this week's policy meeting. Just how much are global markets hinged on indicators out of China at present?
Well, they've become very sensitive to indicators from China. I'd say, in a sense, rather too sensitive. You know, if you get a PMI, the Purchasing Managers Index, comes out, if it's fallen 0.1% or 0.3%, people think this is the end of China. There's an overreaction to China at the moment because, as I said a moment ago, there are so many different factors working. So, you know, any one set of data contains inevitably flaws in it. But the Shanghai market, equity market, has been very flat this year. It's been down about 10-12% at the moment. And the big commodity boom from China it's not ending, but it's reaching a kind of plateau at the moment. So certainly world markets would like to have some good news from China, but I think the preoccupation of the Chinese government is with internal domestic affairs rather than pumping up the economy again and risking it getting out of control as it did in 2009-10.
What then is the next item that markets will be watching as a signal of Chinese strength?
In the medium term, the next thing to watch is a big meeting of the Communist Party, probably held in October, which will determine forthcoming economic policy and particularly the progress of reforms. And we think they'll be cautious in adopting reforms, but will adopt some reforms which will be seen as a good sign. The next figures to look for, as I said, are the second quarter GDP figures, which come out next week with industrial production. And if those stay around 7.5, 7.6%, as I think one would expect, that again is a sign that the new administration is ready to accept lower growth for at least the near-term future and isn't going to be panicked into any stimulus measures. And that won't necessarily cheer up markets very much. And then secondly, if we get reforms coming in the second half of this year, markets may react initially by saying, this is very good, reform is a progressive, good step. But actually, if you look at the real structural reforms that are needed in China, they would knock a couple of points off GDP and a couple of points to inflation. So although everybody wants to reform, it wouldn't necessarily be great for markets.
That's all we've got time for right now, but Jonathan, many thanks for your comments. I'll be back tomorrow with a closer look at Germany. Until then, it's goodbye for now.